So, passive income. It's a very hot buzzword. It's very attractive. Everybody wants to build a passive income stream so they can quit their 9 to 5. So, let's talk about it. Let's talk about how to set up an operation that literally prints money in your sleep without having to start a meth lab in your mom's basement. So, dividend investing in particular is a pretty interesting prospect in the investment world because everybody loves to get up on YouTube, get on their soapbox and sell you these hot covered call dividend ETFs that they think will secure them long-term passive income. And honestly, today I wanted to talk a little bit more about a strategy that's a little more centric on consistent actual real payouts instead of something that's more of an income focused ETF. And at the same time, it also really depends on your financial goals. So, for example, if you're a younger guy, a lot of people will say that you need to focus a little bit more on growth, which is true. But if you're wanting to build a compounding engine that gives you some supplemental income as well, then that's okay. There are options. So, let's talk about it. So, what exactly are dividends? So, dividends are distributions of profits quarterly paid by companies to shareholders. Sometimes they're monthly, sometimes they're quarterly, sometimes they're annually. And they're issued by companies typically that are established and have a long-term winning business model that aren't in a growth phase, so not something like Nvidia. So companies like Coca-Cola, ExxonMobil, they normally have a pretty low yield, so 2 to 4% per year of your holdings. So, say if you hold $100,000 of ExxonMobil, and ExxonMobil is paying, 3%, then that means you're making $3,000 per year, often paid quarterly, into your account. You can also use what's called DRIP, or Dividend Reinvestment Program, which automatically allocates those funds paid out to you in the form of dividends into buying more shares, accelerating your compounding. So it's a great opportunity to also get yourself some extra shares as well if you're not looking for the supplemental income in the meantime. So dividends are pretty hands off, and they will generate you a good amount of passive income. Of course, you would need millions of dollars to be able to live off this amount of money, especially in a more traditional sense, so replacing your 9 to 5. But this is a good way to build a additional passive income stream without sacrificing growth prospects that you'd be giving up by not going into the broader market. So for example, an ETF like SCHD in a given year might return anywhere between 6 to 12%. And for context, SCHD is an ETF that tracks the Dow 100 Dividend King Index. So these are long-term, proven, respected dividend payout companies that are consistently going to provide you with that passive income. And SCHD is sort of like a basket ETF to include all of those. So its current yield is about 3.3%. It pays you quarterly. Personally, in my own investment accounts, I am more invested into broad index funds. So this is like your S&P 500, your total US stock market, international market, small cap. So as opposed to going into something like SCHD right now, it is something that I'm still going to have as a side holding because this is definitely something that I think is eventually going to generate me some passive income that is going to either supplement or even augment my income already from my normal job. So, of course, this does not sound that attractive given that we're talking about 3 to 5% yields on your total holding divided monthly or quarterly per year. And you'd be right. This is not a get rich quick scheme. So if you were hoping for that, bad news for you. This way is really slow and boring. Plenty of these dividend-paying ETFs have pretty low yields, so 2 to 5%, which on 100K of holdings, as we know, is only about $2,000 to $5,000. So, these could be also things like VYM, or on the higher end, something like JEPI, which is more income-focused. I believe it's about 8%. And like I said earlier, there are also these covered call ETFs like SPYI and QQQI, although these are newer and use, instead of actually using the profits from the companies to generate the income payout in the form of dividends, they used what's called a covered call strategy, which is options. This is, a perfectly legitimate strategy in order to generate income paid out to the shareholders. But the thing is, with ridiculous yields like 11 to 12%, the underlying asset itself isn't actually going to appreciate that much. It might go up, say, anywhere from 2 to 4% in a good year, I don't even think that it does that. I think SPYI, if correct me if I'm wrong, is like maybe 1 to 2% in the last year. So the focus of that particular fund is pretty much strictly going to be income based. And so we want to buy something, especially if you're younger, something that's going to continue to generate value over time and even grow. Because while dividend paying stocks, dividend paying ETFs may not grow in the same way as a growth stock, they can still have some pretty significant gains. So, ExxonMobil, I believe, was trading at, $40 to $50 during the peak downturn in COVID. And now it's trading at over $150 and it's still paying that consistent dividend payout. So you would have, more than 3x your investment, which is a pretty great return over the course of that time period, especially when we're considering dividend investments. So to sort of go against a little further against those covered call funds, if you're established and have a lot of money, sure, you can look into a covered call fund for an income stream, but for younger guys, it doesn't necessarily make a lot of sense because we're trying to build our wealth right now. We're trying to, get these compounding engines going, get these dual income streams coming in, and starting that earlier is so necessary. And that's why you don't really want to sort of hamstring yourself and put yourself into these covered call funds because they just don't serve the same function. So to sort of address the main thing, guys who are in dividend gang are always going to rail against, bogle heads, which is the, very boring, slow indexing way, which is another great way to grow your wealth. But fellows in dividend gang will tell you that you absolutely have to do it as opposed to growth because growth, you get taxed more when you sell, and it's only unrealized gain. It's not actual created wealth paid to you in the form of dividends. And there are a lot of people that will also tell you that growth is the way, especially if you're younger. But remember, in order to realize gain on growth, you have to sell, which incurs taxes. But dividends also do the same thing. So it really depends sort of what your goal is long term. Do you prefer to invest into things that are inherently riskier, like growth stocks, which can net you insane gains and can potentially get you a lot of money? If you'd put $10,000 in Palantir when it was trading at $10 a share, a couple of years ago, you would have had an insane return nowadays. The same can be said for companies like Nvidia, Meta, Amazon, so on and so forth. But what if you're investing in something that's a little riskier, like a higher risk tech stock? Something like your Rocket Labs or your ASTS Space Mobiles, things that are not going to pay dividends for a very, very long time because they're not established companies. It just really depends on your strategy. Because if you think that Coca-Cola is going to consistently deliver profits, then, congratulations, you found yourself a very, very reliable and good dividend stock to invest into. So it just comes down to what your strategy is, and you need to personally evaluate that for yourself. So another, I know this is going to sound like I'm shilling for SCHD, and personally I have opened a position. It's not very much, but it's something that I do want to get started on. SCHD doesn't really have any tech exposure, so it's invested in those top dividend king companies that are so reliable and have a strong track record. And they also reconstitute the fund every year, meaning that the holdings are swapped out, depending on the performance. So if it's not going to consistently deliver the same dividend standard that they want, then they just simply swap it out. So dividends are great, but just as sort of a final word of warning, they're also not guaranteed. I mean, for companies that are very institutional and important and their networks are very tied into the world economy, yes, the risk is inherently a lot lower. But as with everything, there are risks. So dividends are great. They're not guaranteed. They can be cut during hard times. And they're also subject to taxation, unlike the unrealized gain of a growth stock. So to sort of wrap up, guys, remember, I'm not a financial professional. I'm just a young guy with a microphone and a computer. But if you enjoyed this video, then maybe consider investing in some of the dividend stocks, baby. Get paid for being a long-term investor, chilling. Just use that DRIP, that dividend reinvestment program. There's so many opportunities out there to grow your wealth, guys. And especially in these choppy waters that we have right now, you could find some deep value. So as always, guys, thank you so much for watching. I really do appreciate it. And have a good day and stay classy. Peace.